Bismillahirrahmanirrahim. So today we plan to cover the East Asian miracle, which is the last topic in this textbook. I will be sending you some instructions on what we will be doing in the next few lectures by email. So watch for that. So did people watch the YouTube video? Okay, that's good. That will be useful as background. So first I'm going to cover this World Bank publication, which is called the East Asian Miracle. So this first part establishes the sense in which this is a miracle. So from 1965 to 1990, there were 23 economies of East Asia, and they grew faster than all other regions of the world. So among these economies, there were 8 which were especially important, and these are called Japan is one of them. Then there's the 4 tigers: the Hong Kong, Republic of Korea, Singapore, and Taiwan. And then there are 3 which are called the NIEs, the newly industrialized economies or newly industrializing economies. That's Indonesia, Malaysia, and Thailand. So those are 8 economies, and they are labeled as HPAEs in this book, which is High Performing Asian Economy. So since 1960, these HPAEs have grown more than twice as fast as the rest of East Asia, 3 times as fast as Latin America and South Asia, 5 times as fast as Africa, and they have also been doing better than Europe and USA and the oil economies. Between 60 and 85, that's 25 years, real income per capita increased more than 4 times in Japan and the 4 tigers, and more than doubled in the newly industrialized economies. So that's quite a performance, and if we could do the same in Pakistan, we would be in very good shape if we could quadruple the real income, and certainly this is possible. Why it doesn't happen is because people have wrong ideas about how to do macro, for one thing, and for another, people are we will see. So this is now the book, what the World Bank book says. What does this is the this is my own ideas. What were the factors? This comes from the Miracle on Han Street YouTube video. So one of the things is that rural development, that's where it started. First, you must have food to create growth. If you're going to industrialize, you have to have a surplus of food. Now, the Pakistan is in bad position currently. It has about 10% of our imports are foods, and we look at the export-import balance, we are negative 2.5 billion. Why should that be? Well, there is a complex of reasons, but one of them is the overvaluation of the Pakistan rupee. So the video showed that you have to start where you are, not try to jump to positions where you can't be. So you take your existing resources and you try to use them in the best possible way, rather than having some ideal in mind and then trying to adapt your situation to the so-called ideal. So when they couldn't start heavy industry, they started with light industry. And one of the things that you learn from that video is that it's the software, not the hardware, that matters much more. And basically the unity and the harmony in Korea was very important. Similarly, in China, Mao Zedong inspired the whole nation to unite on common goals to revive their ancient civilization, etc. So that was very important. And similarly, one of the greatest obstacles to development in Pakistan is the strong conflict between what the elite class thinks of as progress and what the public thinks of as progress. The elite class thinks that they should go to make this into New York and Washington, while the public has some other ideas about what a developed country looks like. So creating harmony, and especially the idea of colonization and the governors being rulers, one of the key things in progress is to empower the people. Empowerment was one of the points. But colonization is exactly the opposite of empowerment. You take all the power away from the people so that you can govern them, because what you plan to do is to exploit them, and they don't want to be exploited. So the interests of the governing class are opposed to the interests of the public, and this same situation has persisted. The framework and mentality remains the same today, and that's one of the biggest obstacles to progress in Pakistan. So one of the major insights from that video on Miracle on Han Street was that basically it's groups that make change. No one person has the power to change anything. So if you look at Ibn Khaldun's history, which is the first book of sociology, in the sense that it looks at the causes for history, he starts with the concept of asabiya, which is basically kinship relationships and tribal relationships. And the point is that this asabiya binds groups together. And this binding of groups together is what creates power. So in the YouTube video, the communities, the villages came together and worked as one group. This is very much opposed to the message of micro and macro, which is very individualistic oriented, but actually we have there is no question that that is a very powerful formula for change, and modernization disintegrates communities, so we are going in the wrong direction currently. So we have actually had leaders who have created communities. Akhtar Hamid Khan was one of them. The Comilla project was a rural development project in Bangladesh, which worked with this basis, and his students have worked in Pakistan. Orangi pilot project was one of these projects. Today, National Rural Support Program and PPPAF, Pakistan Poverty Alleviation Fund, these are also community-based projects. But this fact that communities are the drivers of change is not recognized at the higher levels. And the basic model, which is the mentality of the people who are trying to develop the nations, is top-heavy government-led growth. And this is the wrong model, which will never work, because basically you have very few people in the government and you have a huge number of, you don't have enough leadership capability, you just don't have the numbers. So doesn't mean that government is useless and we should switch to free markets. Rather, what we need is government-assisted, government-enabled growth. So you give the power to the people and you enable them to make change. This is what basically rural development and community development programs were about. But there is always this has been seen by many people, and many such projects have been launched, and they have all failed because of the problem of power. The upper class elite and the government bureaucracies and the people who have power don't want to give up power to the masses, and that causes failure of these projects. This is a graph of the growth rates of the countries in the world. If you look at the top 20, these are the Botswana, China, Indonesia, Hong Kong, Singapore, Korea, Japan. These are again the leading countries in terms of growth. Taiwan is the top second, and China is. Look at the second category, which is the middle 20. Pakistan is right in the middle of that, and many countries are above us. India is at the bottom of the middle 20. This is written in the 1990s, so India has not. India's takeoff started in the mid-90s when they changed their models of government. Actually, they copied models that were instituted in Pakistan in the early 90s, but then our trajectory got disrupted, and they continued to follow the changes that we had started, and unfortunately our growth was disrupted by a number of events. And in the bottom you have the so-called sub-Saharan Africa, Afghanistan, etc. Kuwait is at the very bottom. That's because I guess oil had not been discovered by then. Alright, so this is one other factor which is mentioned. We are now looking at the East Asian Miracle book by GNP and by World Bank, and says that not only has growth been achieved, but it has been spread. I mean, that's the problem with Kuwait and Middle Eastern economies, that the growth has been large amount of money is coming in, but it was very much unequal. A small group got very rich, and the benefits were not shared with the public. Unlike this, these are the countries where you have growth rates. So on the x-axis, so if you look at 7%, then you have Korea, China, Singapore, Hong Kong, and then 6% is Indonesia and Malaysia and Thailand. Now the other axis is the Gini coefficient. So 0 is the average for these countries that are being studied, and if you look at the lower the country is, the more equal it is. So if you see Hong Kong and Indonesia, these are the most equal, and then you have Philippines. Even though Philippines is not growing very fast, it has an equal, high Gini coefficient. I guess a low Gini coefficient. So more equality. Venezuela, Thailand, Malaysia, Singapore, these are the best countries, and then as you go up. So basically one of the contentions is that growth and equitable growth occurred in these high-performing Asian economies. So because of rapid shared growth, human welfare has improved dramatically. Life expectancy went from 56 to 71 years in 30 years. That's very good. The proportion of people living in absolute poverty declined from 58% to 17% in Indonesia, and from 37% to less than 5% in one of these other countries, which in Malaysia during this period. Absolute poverty also declined, but much less steeply. In other economies, and many other social and economic indicators improved rapidly. So there was a lot of benefit that came from this rapid growth. So now we come to the lessons to be drawn, and now we have to think about who is drawing these lessons, because the lessons that the World Bank is drawing from this are very different from the lessons that actually should be drawn. So basically what they start by saying is that there's no surprise that they are doing the right things. which is actually completely false. I mean, there is a big surprise, and a lot of things that are being recommended they didn't do. A lot of what they recommend they didn't do. So actually, it's a big puzzle. In fact, the East Asian Miracle was written by the World Bank partly because East Asia had achieved success by very unorthodox measures, and they didn't want people to follow unorthodox models, so they were trying to justify their own theories, even though they fail completely in the East Asian context. So they start by saying that they did the right things. They had private domestic investment and rapidly growing human capital. So basically, capital is the engine of growth. Now, this is true, and that is you need to have infrastructure and you need to invest in your people. So there is no doubt about that. But how you do that is not at all easy. So to say that you got the fundamentals right is sort of pretty shallow. High levels of domestic financial savings sustains the high investment levels. Again, this is according to our understanding from MMT wrong. What happens is that as you make progress, income increases and it becomes possible to save. So the idea that savings leads to growth is actually inverted. It doesn't happen that way. First you create growth and that leads to savings. So this is a wrong idea. Agriculture experienced rapid growth and productivity improvement and declined in relative importance. These are both go on at the same time. When agriculture grows, you get your food, and then you can feed your industries, the workers who you can feed a lot of workers in the industries, and then you can industrialize. So that will lead to other sectors of the economy growing, which will make the proportion of agriculture smaller. So there is no surprise about that. Growth rates declined rapidly in HPAEs. This is also a consequence of growth. What happens is that when your health starts improving, people target for a certain number of children, and when infant mortality is high, then they have more. And also people use children as a life insurance policy, and again, when you get more prosperity, then people have less children. And also female education is a very strong correlate of reduction in population growth. So the book is trying to normalize growth. There is little that is miraculous. It's largely due to superior accumulation of physical and human capital. This is a rather foolish thing to say, in the sense that it is the policies which led to this physical and human capital. It's like mistaking the engine was mistaking the outcome for the reason of growth. All right, this is an admission of the problem in the World Bank book. In most of these economies, this is written in the East Asian Miracle Report, in one form or the other, the government intervened systematically and through multiple channels. This is exactly, in some cases, this is basically all of these policies are violations of the free market and the World Bank prescriptions for growth. So they targeted and subsidized credit to selected industries. They kept deposit rates low, maintained ceilings on borrowing rates, no free market there, to increase profits and retained earnings by the corporations, and they created these large corporations who would be drivers of growth. They protected domestic import substitutes. They subsidized some industries. They established and financially supported government banks. They made government investments in applied research and shared their findings with the private sector. And this is a very important, actually, externality, that if you have firms doing research, or the private sector, that's they don't have the right incentives, because after you do the research, other people can copy, so that you cannot get full benefits, even if you have a strong patent system, and especially when you don't have a strong patent system, then the same thing is true. So it's not actually worthwhile for firms to do investments. So this is something that the government does, and this is true everywhere. They made targets, export targets for firm and industries, and they developed export marketing institutions and shared information. They promoted some industries and they did not promote others. So basically, this was what you might call government-led growth or policy-led growth. This was not let just the free market, let everybody compete, and whoever is best will automatically go. So then they immediately moved to the question that, well, all of these things were done, but maybe instead of helping these things, they actually hurt growth. How can we know? That's I mean, once you have the ideological position that free markets are best, then if you violate free market conditions, and we were growing very fast, then you can say, oh, all right, so if you had not done these things, you would have grown even faster. Who's to say? So what we have is what is called a counterfactual. What would have happened if the government had not followed these policies? So there is no data to answer this question. This question cannot be answered empirically. So they say that they realize that if you say that purely on an ideological basis, that since these violate free market conditions, they must have hurt growth, that's not going to be very persuasive. So they want to use something which is more persuasive. They said, okay, we come to the judgment that some of these interventions did create growth, but the prerequisites for success are so difficult that other policymakers in other countries should not try this, and people who have tried similar things have met with failure. And it is actually true that the level of many people tried similar policies to support industries and to do import substitution, and they did fail. So basically, it's a difficult job. It's not easy to imitate. So what were these prerequisites that you need in order to make these policies work? One of the key things is performance monitoring and evaluation mechanism. As you put forth a industry, or you subsidize some industry, then you have to check to see if it's working, and if it's working, then you can go further. If it's not working, you make change. This is one of the things which we are very weak in Pakistan, that the Planning Commission subsidizes or funds lots of public sector projects, but we never find out how they did. And actually what happens is that the initial plan is never necessarily good, and you have to make changes on the fly as it's going. But if you are not able to evaluate how it's going, then you can never improve. So what happens is that, okay, this project, it failed, so let's scrap it and let's start from all over, and then you go through the same cycle again, instead of saying, okay, here we tried this had these 3 things went well and these 8 things went wrong, so let's fix those 8 things. That's how you make incremental progress. For that, you need to be able to do performance monitoring and evaluation, and then corrections on that basis. And that was one of the important parts of that video that you watched on performance, that the government looked at the performance, evaluated them. Those who were doing well were rewarded, those who were doing poorly were So one of the so this is a correct deduction. Then it says that the interventions, the subsidies that the government did, were controlled. So you didn't throw massive amounts of money into failed projects, and you tried to do things on self-help mechanism, and you tried to let the private sector take care of most of the burden, and you tried to do minimal subsidies. But when some of things got out of control, then macroeconomic stability was emphasized and chosen. This we would have some question about in terms of the MMT framework. Macroeconomic stability just means not letting the deficits be too high, not using too much fiscal policy. But this needs to be looked on more carefully. And to illustrate this point, the book, the East Asian Miracle, World Bank book, says that in Japan, there was the Ministry of Finance and it controlled subsidies. In Indonesia and Thailand, they had balanced budget laws. And what I would say is that rapid development requires a complex, coordinated, and dynamic interventions. Dynamic means that you have to change things as you go along in light of your experience. And there are many different dimensions of it. There's the software, the hardware, coordination. So it is a complex process, and if everybody is working together for similar goals, then it's possible. But if people are fighting each other for their own power, then it becomes very difficult, and that's the situation. All right, so those are the conclusions from the World Bank report. Now I'd like to just come back to the textbook and what it has to say about the East Asian crisis. It starts with this graph, which is shows that the green line is at the top. It's basically above 6 and 7%. So it's going between 6 and 10%. That's the developing Asian economies, which had 7% growth, compared to the advanced economies, which had much less growth, and Latin America, which also had much less growth. So basically they were doing better than the rest of the world. Now the book says that the multilateral organization, meaning World Bank, mistakenly considered that the rapid growth was product of fiscal rectitude, that is good macro policies, keeping your deficits under control, which is actually the same feeling in the previous government, that in order to prosper you must keep your deficits under control. This is a commonly expressed view, and this we disagree with. And free market dynamics, and both of these are completely wrong lessons. When you have free market, basically what it means is that the resources are used in their most valuable, which means most profitable use, and that creates competition. But the reality was different. The Asian nations built their growth strategies on mix of industrialization, mercantilism, which means pushing exports. Now if you and state-imposed industrial policies. So all of these are very, very different from free market ideas. What is mercantilism? Is basically, mercantilism refers to collection of gold. Now if you look at the fundamental formula of MMT, the fundamental formula is that the government injections plus the foreign injections equals the private surplus. Government injections is the deficit, that is how much you spend, which is more than what you earn. And foreign injections is the difference between your exports and imports. That's the amount of money that the foreigners are injecting into the system, and that's equal to your private surplus. You can make it even sharper by adding government injections plus foreign injections plus private sector banking injections, because the bank also creates credit and it can also provide credit to the private sector. So you can take the financial sector out. These are all the places which normally input money. This input money if the foreigners do a lot of exports, and that's much higher than the imports, then this is money that is coming into the system. So if you try to maximize, so that's going to add up to your private sector surplus and also your private sector savings. So basically, savings would increase, private sector, and profits would increase. And when you are increasing savings and you're increasing profits, this means that you are sacrificing your current standard of living, goods that you could eat today, in order for future. So that is, as we said, exports increase the standard of living of the foreigners, and imports increase our standard of living. So there's no contradiction between that. So these nations, the state played a major role in the development and defied the advice offered by IMF and World Bank. There is a book called 50 Years is Enough, in which they have analyzed the 50 years of experience by World Bank and IMF, and basically you can say that any country over the world which has followed IMF and policies and World Bank, none of them have become successful, and many of them have become basket cases as a result of their advice. So you can say that this model is a failed model, but the model is not followed because of the desire of IMF and World Bank to create development. It has some other purposes. In fact, you could say that it has the purpose of keeping countries underdeveloped so that they will get loans from the rich countries, which will keep them under their political and financial control. And this is why we see constantly recurring cycles of you borrow and then you follow wrong strategies and then you fall down again and then you are given aid which allows you to stand up again and then they kick you down again. Yes?
So isn't it also an intent to to eliminate the possibility of socialism ever emerging again?
Yes, that's certainly true. That's also true. So this group thinks that the trade-led growth comes from exploiting the comparative advantage. However, South Korea selected and supported several key sectors to be their growth engines, even though none of them had any resource advantage. They started a semiconductor industry from scratch. They started chemicals industry, even though there was no local benefits or resources which would support that. So this idea of comparative advantage is just a myth. You can create comparative advantage by investing in any particular sector. So the governments, in fact, interfered with the market in many ways. They provided credit to targeted sectors at low interest rates. Tax breaks were given to firms to increase profits. Protection was given to local firms against imports. And heavily investments were made in public research and development, and these results were shared with the industry. Now that's how the miracle occurred, but now we come to how the crisis occurred. So in early 1990s, the capital resources were shifting from tigers to China. Tigers were far ahead of China and India at that time, and so China and India had cheaper labor, and both China and India had shifted from full state control to more free market models. And in fact, the free market advocates are very fond of saying that, look, China has had miraculous growth because it shifted from communism to capitalism. But this is a very misleading understanding of the situation. Actually, China had a very strong state organized production system. All the production was done by the state. Now they have slowly shifted gradually to more free market methods, but still about 70% of the production is done by state-owned enterprises and only 30%. So to say that the growth is caused by free markets is a grave misunderstanding of the situation. But certainly they were extreme on the other side, and they've gotten to a much better balance. And certainly free market models with the right kind of government policy can work well. it's the unregulated free market where anybody can do anything and profits is the only goal that causes heavy amount of damage. Because of this, the Malaysia, Taiwan, South Korea, Singapore, and Thailand were being competed with by China and India, and investments were shifting there, and the growth rates of the tiger nations were reduced because of this. And there were certain other shocks. The Chinese renminbi and Japanese yen were devalued. This devaluation is what is one of the cheapest and easiest policies for growth. As we have seen, if the government tries to keep the rate above equilibrium, then the government has to keep borrowing in foreign exchange, and it leads to a structure of industries which is not competitive, in the sense that when you are able to import cheap goods, you can produce goods and sell them at profit, but that profit is artificial because you were able to buy inputs at subsidized rates where the government was paying the dollars. And that's why we can buy tomatoes from India, because the government pays for them by subsidizing. So that's why our overvaluation is a very disastrously wrong strategy, and over the past 30 years we've followed this. This strategy is wonderful for the elites who can buy luxury goods at cheap prices from abroad, and terrible for the nation as a whole. So devaluation of the Chinese currency and Japanese led to the opposite. When the government wants to keep the currency cheaper than the equilibrium, then they will accumulate reserves, and China has $1 trillion reserves, and Japan also has huge amounts of dollar reserves because they kept their currency undervalued. There was a fall in semiconductor prices, which led to a fall in their export earnings. The growth was also accompanied by a boom in real estate. Now, this is the part which is important. Sometime in the early 90s, there was push for financial liberalization, and so the East Asian countries, they had very strict capital controls. Nobody could buy their currencies, and their currencies could not be easily converted to dollars or other hard currencies. So in the 90s, these were relaxed, which allowed, actually these were relaxed at the pressure of the financial lobby outside, because huge returns were available in the developed countries, so-called the rich countries, the Europe and the USA. The returns on capital were very low. You could only get 2%, maybe 3%. And here in East Asia, you could get, and the growth rates were around 7%, so you could get returns on your capital of that amount. So a lot of foreign capital flowed in with the temptation of high returns. Now, when lots of capital flows in, the easiest and cheapest and what seems to be the safest investment turns out to be real estate, stocks, properties, and that is what happened. There was a boom in real estate as foreign capital came in and sought high returns. It was invested in real estate, and these, unfortunately, the loans that were taken to do this were in foreign currency, so that the exchange rate risk was taken by the country and not by the foreigners. As long as foreigners invest in your currency and they take the risk of the exchange rate, it's not so harmful. But the private sector took loans in foreign currency, and that meant that in order to pay back the debt, you had to have your export income, which was declining at this time. So the crisis began in 1997 when the foreign debt became very high, and the baht was pegged to the dollar, and basically it was triggered by just some speculation. People who were analysts saw that they were doing these sustainable debt calculations, which, as the textbook points out, are nonsense, because all government debt in local currency is sustainable. But when you have a peg, this is not true anymore. Then you look at your debt service obligations in terms of dollars, and you look at your reserves, and you see that the debt might not be serviceable. The government might default on its payments, or more likely, it will not be able to convert the baht to a dollar at the pegged rate because it doesn't have enough money to do so. So what will happen next? They will depreciate. So once some people made this calculation, they started taking millions of dollars out of the economy, and so this hot capital flow caused a huge loss in the change in the money supply, which led to a contraction of the money supply, which led to a recession, and it created a self-fulfilling prophecy. As the dollars move out, your sustainability position becomes even worse. More people start to move their dollars out, and then you cannot support your exchange rate at the pegged rate. So there was a collapse in the currency. Now there is what the textbooks suggest later is that there should have been a bailout at this point. The IMF and the world, if they had said that the currency, the economy is fundamentally sound, which it was, and these are just short-term speculative problems. Some people have the wrong idea, and as long as you go and support your currency in dollar terms, this crisis would not have happened. But basically, once the currency did collapse, the government floated the baht, and because it could not maintain the pegged exchange rate, and the value fell by more than 50%, as the international investors who were speculating, and they didn't have any, basically this, you see, you have two types of investment. There's real investment, people who are investing in real projects, and then there's gamblers. Now, if you were using an Islamic system, there would be no gamblers. You are not allowed to gamble in currency. So as long as you invest in baht in a real project, whether it's a house or whether it's a factory, there is no harm. This is permissible. In that case, your asset is still there. You can't have massive fluctuations in prices. Massive fluctuations occur because of speculation, as we will see later. So the currency collapsed because of speculation. There were lots of bahts who were just hot money, and it flowed out. It caused the collapse in currency. It made the nation bankrupt because they owed loans in foreign currencies which could not be serviced anymore, and several major financial institutions became bankrupt. So basically, these events expose the danger of maintaining currency pegs, which pegs, you see, can be always destroyed by the international finance. They have billions of dollars to play with, and they can just attack any currency and take it down because they have so much money that small nations can't compete with them. They even took down the Bank of England, which is not a small economy, by gambling billions of pounds, and so that's not so. Basically, one needs to prevent this gambling, which could be done by Islamic laws, but currently there is no such proposal on the horizon. So basically, if you have an exchange rate peg, then you are vulnerable to an attack. Once people saw that the Thai economy went down, the speculators who had millions of dollars invested in the East Asian tigers, they decided that this risk is too high. They decided to withdraw money, and even though there was nothing wrong and nothing changed in the other economies, and there was no link between the Thai economy and the other economies. This withdrawal of massive amounts of hot currency caused a collapse in the currencies in Indonesia, Malaysia, Philippines, and then this crisis spread to Hong Kong, Singapore, and Taiwan. And capital outflow from South Korea forced it to devalue. Then the banks that had made short-term loans to these nations could have, when they became due, they could have rolled over the debt, which means that extend another short-term debt, but they didn't, and this created a credit crunch. And at that point, basically, US, Japan, and European Union could have intervened and given enough liquidity to stop the capital outflow, and they would have been safe in the sense that since the economy, there's nothing wrong with it, it was in a position to earn a lot of dollars. It had been earning hundreds of billions of dollars in exports, and it could do so in the future again. But because of this failure, this created the East Asian crisis. Instead of creating a bailout, the IMF made things worse by imposing wrong policies. Just after printing a report in something like August 1997, saying that these are wonderful economies and they're doing very well and they have great policies, and in fact partly praising itself that we have pressurized these countries into financial deregulation so that the capital can flow in, and that is one of the causes of their rapid growth. Just 2 months later, this capital that had flowed in caused the collapse of the economy, and then the IMF started saying that the Asian governments are very bad and they have irresponsible fiscal policy and they have crony capitalism and they have all of these mistakes which they were unable to see just 2 months earlier, and that's why they collapsed. They didn't say that our wrong policy advice was the cause of their collapse, and a series of policy blunders were made later which deepened and spread the crisis. If the IMF had managed the crisis correctly, it would have been a short-term temporary problem which would have been easily resolved. So instead of helping, they said, okay, we'll bail you out, we'll give you the money, foreign exchange to pay off the loans, but now you have to increase your interest rates and you have to make a fiscal policy, bring down your deficit. This is what was heavily criticized by Stiglitz by saying their one-size-fits-all approach, because the fiscal policy in these nations, the budgets were in balance. You see, the private sector surplus was being driven by the exports, so it was the foreign injections which were creating so the government budget did not need to be in deficit to provide the private sector surplus. So this approach of fiscal contraction and high interest rates is never actually very good, but in these Asian economies, inflation was stable, so there was no need to push up the interest rate, and there was budget surplus, so there was no need to do fiscal contraction. This was basically the result of capital liberalization. The East Asian crisis was a result of capital liberalization that led to a massive capital inflow between 1993 and 1996. What should have been done was to keep the capital controls, allow the people to invest, but only in local currency, or let the exchange rate be free. Now, we will discuss this issue a little bit later. So when capital flowed in and then the export growth became slower for the reasons that we have discussed, then the repayments were made difficult, and this allowed this hot capital to flow out of the economy. Then IMF made sure that the crisis became a full-blown economic crisis by interfering with the domestic fiscal and monetary policy, which it shouldn't have done. And actually what was called for in a contraction is exactly the opposite. Instead of high interest rates, you need low interest rates and expansionary monetary policy and high fiscal deficits in order to handle a domestic recession. And exactly these policies were followed in USA and Europe following the global financial crisis, where they had expansionary fiscal policy, zero interest rate, and high deficits to combat the recession. But in East Asia, exactly the opposite policies were recommended by the same economists. I wonder why. Keep high interest rates and do contractionary so as to make the recession even worse. The IMF said that there are 16 banks which have become insolvent. So whereas in the USA, these banks which had become insolvent were bailed out by $1 trillion loan in the global financial crisis, the IMF forced the government to close them down and said that this would restore confidence. Instead, exactly the opposite happened. When the 16 banks closed down, there was widespread panic that any bank can close any day, and the government had to inject about 5% of the GNP into the remaining banks to save them, because everybody was very nervous and started withdrawing money. And so basically the Asian financial crisis was the result of lack of regulation and capital flows combined with currency pegs and mismanagement of policy. In summary, Asian financial crisis was a result of lack of regulation and capital flows combined with currency pegs. The currency pegs basically interpreted by the financial markets that, okay, we are safe against the currency exchange risk. And they, when the government was forced to relax them, then they, because they thought of themselves as being safe from exchange rate risk, they did not hedge their position. They did not take any precautions against the possibility of the currency collapse. So when it happened, it took everybody by surprise, and that led to many firms becoming bankrupt, even though they were financially sound. So what is capital controls? Basically, Malaysia was the first country who defied the IMF advice. They said, no, we will not follow it. They imposed strong capital controls. They did not accept bailout packages, and they recovered the most quickly from the crisis. So basically the lesson is that large-scale financial speculation can undermine a real economy very quickly, especially if you have pegs or if you have significant foreign currency debt exposure. So while international community could agree that certain forms of speculative activity would be illegal, and that's really the solution, the Islamic solution, make speculation, make gambling in large amounts in foreign currencies illegal. But if that's not true, which is currently not, the financial lobby holds control and they like all this gambling, and so they don't want it banned. So in that other case, we have to take our own precautions. And one of these is capital controls, basically prevent people from investing in your economy, or actually be selective. And in fact, the paper which I was planning to cover, I haven't, is that basically what we need is financial services, and these are good and these can be provided, and you have to distinguish between capital flows and the provision of financial services in foreign capital. So you can provide capital services without having free capital flow. And this is a very important distinction which is currently not made. But if we want to say that, okay, we want to have liberal capital services, anybody who wants to use dollars for his business should be allowed to use it. But basically you have to tie earnings to, and you have to basically make sure that if you're spending dollars, you're earning dollars. There are many ways to ensure that. So for example, if a firm is getting imports and then producing goods and exporting them, then it's immediate that they should get dollars easily, and they can pay back in dollars when they export. But this can also be done at an economy-wide basis. And what happens is that what Stiglitz has suggested is that you earn coupons in dollars when you export, and then anybody who is importing has to buy those coupons, so that automatically the exports is balanced to the imports. And that's Stiglitz's suggestions for how we can manage BOPs. But the capital controls is basically making sure that anybody who takes rupees and wants to buy dollars, he has to justify this, and it has to be within the parameters. You can't go and buy anything you like from foreign countries. The Malaysian country introduced capital controls. So there, and that really was very helpful in overcoming the crisis. After they got their economy under control, then the capital started flowing in. So Malaysia, having been bitten once, decided that it should control this, and there are direct controls. People are not allowed to convert their currencies, and there are indirect controls which basically involve putting certain kinds of taxes on currency conversions. So capital controls can be limits on foreign exchange transactions, basically the goal of this is to make sure that these gamblers don't get to gamble in your economy. Anybody who wants to invest, that's fine, acceptable, desirable, but people who want to gamble in your stock market and basically take advantage. So this, what happens on Wall Street, can also happen in any country, that huge amounts of money is put into your real estate or into your stocks, which causes the prices to boom. At the peak, people just sell out and leave with their money. This causes a collapse in the stock market. And also, where did this gain come from? It came from basically there are some sharks, and then there are the masses, the pool of, and so these sharks eat up huge amounts of savings of domestic population who are naive and unsuspecting. Okay, so capital controls allow the central bank to run autonomous monetary policy and the treasury to use fiscal policy to manage domestic demand. Basically, all of these, the autonomous monetary policy and fiscal policy, become compromised when you have foreign debts and you have to pay debt, whether it's the private sector or whether it's the public sector. If you have to pay debts in foreign currencies, then you cannot control your monetary policy. So this is the last slide, I think, and this is one very important lesson which we will discuss later, the trilemma. So everybody knows about the dilemma, which means doing one of two things. Trilemma is based on three things which cannot be done all at the same time. So basically, these three things: you can't have free capital flows, fixed exchange rate, and independent monetary policy. All of these three things cannot be done at the same time. You can have any two. So if you restrict the flow of capital, you put in capital control, then you can have a fixed exchange rate and an independent monetary policy. And this is probably the best option of the A, B, and C. There are three options we have. We can say we have fixed exchange rate and allow free flow of capital. Then monetary policy is not under your control, because depending on how much people invest in your economy and how they withdraw, the money supply will be fixed because of the fixed exchange rate. This is the situation in the European Union, for example, where they have no independent monetary policy. So this allows free flow of capital. Anybody who wants to can invest in any one of the European Union, and so this is a benefit. But the loss is that, for example, Greece and Ireland and Spain and Italy, they have all suffered recessions, and they cannot follow expansionary monetary policy or run deficits to help improve their employment situation or domestic economy, because the fixed exchange rate to the euro, in fact the use of the euro, allows free flow of capital, and then that makes it impossible because the money supply is not under their control anymore. So A is the option for the European Union, and it doesn't allow. And then you can have B, which is the MMT preference, that you allow free flow of capital and you don't interfere in the capital markets, and then you can have your independent monetary policy. So B is the recommendation of the MMT. The reason that I don't like that, and the reason I prefer the C option, is that the fixed exchange rates have a lot of things to offer, in the sense that it allows you to plan over a long horizon, whereas when you have free flow of capital, the exchange rate fluctuate a lot. So there is a benefit and a disadvantage. If you have a lot of if the the exchange rate is very variable and erratic with different currencies, then basically what you need to do to create viable industry is to have a lot more self-sufficiency. You should try to produce more domestic goods, so that the risks of the foreign exchange risk you can minimize. And so that is also actually a good thing. It teaches you to be independent. With the fixed exchange rates, you are given a prop by the government. This should be adjusted. The rate should be fixed in short horizon, but it should not be allowed to be fixed at, especially if you fix it at a lower value, which is below equilibrium, then you can basically accumulate capital, encourage capital inflow, and allow businesses to plan in the import-export business can be done much better, because the businesses can plan what they will be earning and what they will be spending. Their costs and their revenues they can plan, which would be very much more difficult under a floating exchange rate. So there are benefits and disadvantages. If you fix the exchange, it makes it planning easier, but then it shifts a lot of risk onto the government, and it makes the government has to make sure that the disequilibrium doesn't come about. And if you fix the exchange rate at the wrong level, you can encourage the development of negative value added industries, which is what has happened in Pakistan, because the exchange rate was fixed at a overly high level, and so a lot of industry which has developed is adapted to this condition where the imports are cheap and exports are at a high level. What you produce you can't export at market levels because your domestic costs are high in terms of foreign currency. So now this is something which is very difficult to change, because if you change this will cause the collapse of a lot of industries which has developed under the wrong conditions. And yet this is what needs to be done. So you have to inflict a lot of pain on the domestic economy. not by running austerity. This is a different kind of pain, because the wrong kinds of industries have developed because of the wrong price structures. So now you have to change the price structures. This will cause these industries to collapse, and new industries will emerge which will be adapted to the new configurations. These industries have not emerged because the domestic cost has been, for example, palm oil industry. We are importing palm oil seeds from Malaysia and making oil, even though we have lots of desert and because the cost of producing domestically is so high that it's cheaper to import. Now, if we increase the exchange rate, if we depreciate the rupee, we will then it will become profitable to create a palm oil industry, which doesn't exist currently. So, but this will take an year or two at least, maybe more, to develop a domestic industry. And so there is a transition cost which needs to be managed intelligently. This is what also the movie showed, that if you start from scratch, the pain is already there. The only issue is to target that pain to the right goals. And if you do that, then you can use that pain and suffering and sacrifice to create a better future. Today, now we have a problem that we have to inflict pain, and then we have to use that in the right. So it's a dilemma and a difficulty for Pakistan to make good development strategy today. All right, so that's all for today. For next time, I will give you some assignments on this textbook is finished, and